This is not financial advice. I'm not a financial advisor, so don't base anything I say off these videos. I'm just doing it for pure entertainment purposes only. Want to jump in real quick. So, talking about taking profits off the table after you've invested for a while. One thing to know is if you do take a profit, let's say you invest in something and a day or two later you pull out, you're going to have to pay capital gains tax. I'll do a separate video on that. And also this is more for new investors. So if you're already a solidified investor and you don't want to hear what I got to say, it's fine. Move on. But it's always good to refresh. You might hear something you didn't think of or might trigger something. Anyways, so yeah, let's say you go in, you find your broker, you find the stock you want to put it in, put some money into, you throw $100 in, and boom, the next day it goes up like 25%, and you decide, you know what, I'm going to take my profits, and you pull out, $25. So that $25, what you've pulled out of profit is going to be taxed at the end of the year. So just keep that in mind. Or if you pull the whole 100 out, it's only going to pull it's only going to tax you for the profit. You're not going to get taxed for the money you entered in. So you're only going to get taxed for the profits. And if you pull out a loss, obviously they're not going to tax you on that. So you don't get taxed. I've heard some misconceptions that, you get taxed like if the stock goes up and you don't pull out. You only get taxed once you pull it out. There is other ways. I believe you can cash out and put it directly into an IRA or a Roth IRA. And those are things you can look into yourself. But just for the basics, you put your cash in, you pull it out, you will get taxed unless you keep it for over a year. You will still get taxed, but it won't be a short-term capital gains tax, which will be less, significantly less. I want to say it's like 25 to 37% when you pull out before a year. It's quite a bit, so consider that. If it's something that's just very profitable and you want to pull your money out, people do it all the time, you know what I mean? But it will, at the end of the year, they'll calculate it in. Also, if you hold it, I believe it's over 2 years. After you hold in your stock for 2 years and you pull it out, it's even less. So, you can do a quick Google search and find out the exact amounts. If you know the stock you want to pull out, check the date, say, okay, it's been 2.5 years. You can Google it. Pretty simple. But basically, anything before a year, and most brokers will give you the option to look at, you look at your trade history. And usually if you scroll to the right, it'll tell you short or long. So if it says short, that means you're going to get short-term capital gains tax if you pull out. It's only been held for under a year. Long, I'll show you the full. It's been there for a year. Also, another thing to consider is if you do pull out at a profit. Let's just say, for instance, you're in. Say you're in AMC. You pull into AMC tomorrow, you put $100 in, and somehow it goes like $500 a share, and you want to pull your profit. You do pull your profit, and then the next day it goes up like 500%. You really can't look back. Once you pull the trigger and you make your decision to pull your profits, don't look back, because you don't want to beat yourself up. You know what I mean? You don't go. It's like when you start dating someone new, you don't start talking about their exes. It's not fun. It triggers things. It's not a good idea. You know what I mean? It's just, so you move on, move forward, learn for the next time. You know what I mean? You can go back and look at the chart and say, what did I miss? What did I do? But a lot of times, that's happened to me many times. I've pulled out profit and the next day it goes up another 25%. And it's, and it always works like that, because the stock could have been sitting at negative 10% for a year. It goes up 20%, and you decide, I'm getting out of this stock. You get out, and then the day after you get out, it goes up another 25%, and it'll pull itself back down. But those are the things you just can't look back. Make the decision, go with it. There was something else I wanted to cover in this video, and I'm trying to remember what else it was. Anyways, this is some kind of basic ideas for new investors. Also, I would advise, do your own DD, do your own research. DD is due diligence, obviously, if you don't know that. Sometimes, it sounds silly, but when I came into the market originally, I was like, why do people keep saying do your DD? Just do your due diligence, do your research. A lot of times if you invest in a company you don't believe in, or you don't know what the CEO is about or how they run their company, it's going to be hard to hold through bad times, because as soon as it goes red, you're going to want to sell. You don't believe in the company. You don't believe they're going to pull up. You don't really know. So it is also a good idea to do your research, do your due diligence, know about the company before you invest. That way, it is going to go red. There's no way, most trades I've ever been in, I've never just gone green, 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 sold. It's usually green, green, and then all of a sudden you dip down to some red. So, and at that point you can decide, do I believe in the company? Do I believe it's going to go higher? I wish I would have had more shares, and now that it's red, I can add more shares and average down, make my average cost go down. So when you're buying a stock, and let's say you buy it for $5 and it dips down to $4, that means your average price is $5, but the stock's at $4. You can add more shares, and it'll average you down a small percentage each time you buy, unless you're buying huge chunks. But that's like with people with AMC always talk about, after the reverse split. That's a different video. But if anything, if you go in the red and the line is red and your stock's underneath, but you still believe it's a good company and it's going to pull through, and you wish you had more shares, it's a perfect time to do it when it's red, because you're not up in your average, and it's just generally a good time, in my opinion. So form your own opinion, make your own decisions, but those are the kind of things I do. Kind of some basics of the market for the new beginning trader. I will say, there's a lot of platforms out there, user-friendly ones, even though a lot of people don't like it. Definitely Robinhood, Webull. But after you get going a while, you can kind of do your research on why some people don't like Robinhood. I'm not bashing Robinhood. I've had shares on Robinhood. But, a lot of people go with a more solidified, I guess, broker, which would be like Fidelity or Charles Schwab or places like that. But, you've got tons of options. You got Public, you got Moomoo, whatever's easiest for you. But I will say beginning stages, Red Bull. I need an energy drink. I just passed the coffee joint. Robinhood and like Webull are definitely a couple of options I would go with. Well, for user-friendly easiness, but it's totally up to you. You can get on the platform and kind of move around and see how you like it. Other than that, man, if you have any questions, hit me in the comments. I'll try to respond back. And go from there. Have a good day. Be blessed, and hopefully you get rich soon. Peace.